This video is for class 19 if you're in Monday, Wednesday, Friday classes, and it is class 13 for Tuesday, Thursday classes. So we're talking about merchandising companies. So in chapter 5 we learned that we have to add inventory and cost of goods sold to the types of accounts we're considering. And we learned how to do our income statement slightly differently, computing gross profit, and we just talked a little bit about merchandise in terms of it's this new account and we're going to be using it when we make purchases or sales. Well, it continues to be important through chapter 6, and we're going to just drill down a little bit on merchandise inventory and the expense associated with it, cost of goods sold. We're basically going to talk about some different ways to calculate that now. So everything you learned from chapter 5 still applies, but we may just add a little bit of information about inventory. Before we do that, we're going to talk about some basic principles that apply to all accounting we do, but they're especially important for inventory, so we're going to stress these new principles at this point in time. All right. There are several principles on which the foundations of accrual accounting are built. Some of those principles are consistency, full disclosure, materiality, and accounting conservatism. These principles are discussed in this presentation. So let's talk about consistency first. The consistency principle states that a business should use the same accounting methods and procedures from period to period. Consistency helps investors and creditors compare a company's financial statements from one period to the next. Companies must be consistent in the accounting methods they use. If changes are made in accounting methods, the company should communicate the changes to the stakeholders. So this is important. We're going to learn a couple different ways to count for inventory, right? And you can't just choose which one you want to use this period and use a different one next period because it makes your accounting look better. You have to be consistent. That way people can compare across years. So consistency principle applies all over accounting, but it's especially important for inventory. Next, disclosure principle. The disclosure principle states that a business's financial statements must report enough information for outsiders to make knowledgeable decisions about the company. So we can't hide things by just not disclosing them. If it's important to outsiders, if they need to know about this to make a good decision, you can't just not disclose it. So let's give an example of some disclosures on this next slide. So here's an example disclosing inventory information. It explains how this company does their inventory. The notes to the financial statements contain important information summarizing the accounting policies of the company. For example, Green Mountain Coffee Roasters, Inc. discloses the accounting policies it uses to ensure the company is providing full disclosure to its investors and creditors. So we've talked about the financial statements and we've prepared them, income statement, statement of retained earnings, balance sheet, and we talked a little bit about that cash flow statement. But that's not all there is to disclose. You can imagine there would be a lot of information that's not contained within those 3 or 4, depending on what you're looking at, 3 or 4 financial statements. There's other information like, I see that you have merchandise inventory on the balance sheet, but how did you calculate that? And that's what this disclosure is explaining. So actual full set of financial statements is going to have a lot of these disclosure paragraphs that helps people understand more information. The concept of materiality, very important concept. The materiality concept states that a company must perform strictly proper accounting only for items that are significant to the business's financial situation. In essence, the materiality concept recognizes that the size of the dollar amounts in transactions is most relevant when compared to the overall size of the company. For example, A $10,000 transaction is very relevant to a $100,000 company. However, to a $1 billion company, a $10,000 transaction is probably not large enough to, of itself, impact the decision of a stockholder or creditor. So this idea of materiality doesn't mean that we don't care about anything that happens under a certain dollar amount, but it just means that it's okay to maybe not count the paper clips in the supply closet. You know, if you're Walmart, your inventory is very important, but maybe some office supplies in one particular store is not very important. So it needs to be something that would impact enough to make a decision turn out differently. So we call that materiality. The example I was always told in accounting was we don't count the paper clips. All right, and finally, conservatism. The conservatism principle states that a business should report the least favorable figures in the financial statements when two or more possible options are presented. Basically, conservatism is choosing the accounting treatment that is least likely to overstate assets or net income. So if you're being conservative, and especially about inventory, you should be conservative. You know, some inventory might not sell for as much as you thought it would. So just to be conservative, you'll write it down, right? Let's take the example of those tablets that we were using last chapter. The Smart Touch company bought tablets and they put them in their inventory. They paid $350 each, so they were inventoried at $350 per tablet. Well, let's suppose a new fancier tablet came out and it was $350. Right? So now people prefer that tablet, right? This happens a lot with technology. It keeps getting better and better, but you know, it doesn't really cost all that much more. So you got this new fancy tablet that's $350, or you got the old plain tablet that's $350. Well, of course, people are going to buy the new fancy one. So that really means our tablets that are in inventory aren't worth as much, right? Because we can't sell them for $350. Maybe we could sell them for $200 or something. So we need to be conservative and mark those down, right? That's what conservatism is about. Yeah, maybe somebody might buy a few of them for $350, but we should probably be conservative. That's what conservatism is. Control over merchandise inventory. So we haven't really talked much about this concept of controls, but it's something that you've all seen and you know about. The controls are just really the policies and the procedures that make sure that the inventory stays safe, right? It doesn't get stolen, and that the numbers on the financial statements are correct. So we have rules and policies and procedures, right? They don't let just anybody go into the stockroom at Best Buy and come out with a TV. You have to work there, and you have to have passcodes and things. So you couldn't just have any old body walk in there and walk out of the store with a TV. In fact, last time I was at Best Buy, they checked your receipt, compared it to what you had in your sack. So that's a control. They're making sure nobody's leaving with something that they didn't pay for. So that's what we mean by controls, just whatever rules, policies, procedures are in place. So maintaining good controls over merchandise inventory is very important for a merchandiser. Good controls ensure that inventory purchases and sales are properly authorized and accounted for by the accounting system. This can be accomplished by taking the following measures. The company should ensure that merchandise inventory is not purchased without proper authorization, including purchasing only from approved vendors and within acceptable dollar ranges. After inventory is purchased, the order should be tracked and properly documented when received. At the time of delivery, a count of inventory received should be completed, and each item should be examined for damage. Damaged inventory should be properly recorded and then should be either used, disposed of, or returned to the vendor. A physical count of inventory should be completed at least once a year to track inventory shrinkage due to theft, damage, and errors. When sales are made, the inventory sold should be properly recorded and removed from the inventory count. This will prevent the company from running out of inventory, often called a stockout. So lots of rules, policies, procedures, all to make sure those numbers in inventory are the correct numbers. So let's move on and talk specifically about keeping track of that inventory. We've already talked about it a little bit, and now we're going to get into, I guess I would call the details of tracking inventory. At the end of each fiscal period, 2 accounts reflect information about inventory: merchandise inventory and costs of goods sold. So merchandise inventory, that's the current asset where we're tracking our actual inventory, what we have in our stockroom. Merchandise inventory asset. Cost of goods sold, remember that as we sold inventory, we recorded the sale, right? We put sales revenue, we put cash or accounts receivable, right? Then we debited our expense, cost of goods sold, and we credited the merchandise to get it to lower that merchandise. So cost of goods sold we have to track. The number of units in merchandise inventory at the end of the period can be determined by physically counting the amount of inventory owned by the company at the end of the period. The number of units sold during the period will be determined and then multiplied by the per cost unit of the inventory. So what this is saying is, at the end of the year or the month or whenever it is that we're going to sit down and determine our inventory and cost of goods sold. Yes, we've been recording it, and we should have the right balance, but remember there's shrinkage. So we go in and we actually count it, physically count, and we say, okay, we have this many units, right? So for Smart Touch, yes, we've been recording those tablets as they came and went, right, as we purchased and sold. But you know, what if some unscrupulous person snuck a couple out? And what if one got dropped on the floor and broke? So they got taken out of inventory, but we really didn't know it. They were no good, something like that. So we went through and we counted, and we found out, well, how many really do we still have? We thought we had, 750 left. We really only had 700. So what do we pay for them? $350. So that's the per unit cost. And so now we know how much inventory we really have. We know what the book said when we did our purchase and sales and returns and all that, but what do we really have? We went and counted. So that's what we actually did. So let's look at our example here. So when the cost of inventory does not change during the month, the assignment of dollars to ending inventory and cost of goods sold becomes a fairly easy exercise. Simply multiply the number of units on hand by cost per unit. Likewise, multiply the number of units sold by cost per unit. So in this example, every tablet we bought cost $350. So we purchased 4, we sold 4, we purchased 12, we sold 10. So we purchased 16, we sold 14, we have 4 left in inventory. If we paid $350 for each of them, that's 4 times $350, or $1,400, right? We know we sold 14, so 14 times $350 is $4,900. So pretty simple. That's what we've been doing. All right. Now, we know that in real life, costs go up and down, right? Just think about gasoline prices. It seems like it's different every time I purchase it. All right. When the cost of acquiring inventory changes during the period, it becomes more unclear how much cost should be applied to each unit in ending inventory. So as you can see in the example, we have the same thing going on with the same 16 tablets being purchased, 14 sold, 4 left, but in this case, we paid different amounts for them. So we can't just go $350 because that's not what we really paid. All right, so there's 4 choices, right? So we're going to sit down at the end of the month and we're going to figure out about those tablets. What was the cost per unit? So we can figure out inventory and cost of goods sold. Well, there's 4 ways of doing this. 2 we're not really going to worry about. I'll tell them to you here, but that's it. Don't worry about it because we're only going to do these middle 2. First is specific identification. right? And next, first in, first out, last in, first out. And then finally, weighted average. So we're not going to use specific identification, and we're not going to use weighted average. We're only going to worry about the middle two, FIFO and LIFO. Basically, there are 4 approaches that are acceptable according to GAAP for computing the amount of dollars to assign to ending inventory and to cost of goods sold. An inventory costing method is a method of approximating the flow of inventory costs in a business that is used to determine the amount of cost of goods sold and ending merchandise inventory. The costing methods are specific identification, first in, first out, last in, first out, and weighted average. For this course, we will only consider FIFO and LIFO. So the first one, specific identification, not used. But it's just like it sounds. You actually track each thing exactly as it's sold. So you'd use this for a big item with a serial number like a car, right? So you can track those, you know exactly what it costs. The next thing, weighted average. For small trinket type items, you know, if you have office supplies, you know, things that you sell a bunch of parts, you know, you're a machinist and you manufacture a bunch of nuts and bolts and things like that, you just can take a weighted average. But we're going to do first in, first out, last in, first out. FIFO and LIFO. All right, so let's talk first about FIFO. The first in, first out, or FIFO method is an inventory costing method in which the first costs into inventory are the first costs out to cost of goods sold. Ending inventory is based on the cost of the most recent purchases. When using perpetual FIFO, we account for each purchase and sale as it happens when we sell items. When we sell items, we are usually unable to identify which specific items we have sold since they are all homogeneous. For accounting purposes, we will assume that the units sold were the oldest units in inventory at the time of the sale. We will remove the oldest units along with their costs from the inventory record, leaving the newest units available as part of ending inventory. So first in, first out means, you know, if I purchase it, the oldest one is going to be the one I give to the customer. Now, it may or may not really be the fact. I mean, it's kind of easy. You know how we rotate stock in a grocery store so the oldest stuff is always at the front, or they're supposed to? Well, you can imagine that's how we're supposed to. So the oldest thing is what I'm giving to the customer. May or may not really be, but we're going to account for it that way. First in, first out. So let's look at this example of first in, first out. So Smart Touch Learning began August with TuTh13. So this is the unit we're tracking, right? So we're tracking some units that are TAB0503. That's just a stock number. They cost $3.50 per unit, right? So here we go. We have 2 units, $3.50. There's our total cost, $700. Then we bought 4 more, but they cost $3.60. So here's 4 times $3.60 total cost. So there you go, 2 units at the old price, 4 units at the new price, right? And there's our total, all right? Now we have 6 units. On August 15, we sold 4 units. So according to FIFO, first in, first out, we sold 2 units at the oldest cost, and then 2 units at the new cost, and that leaves all the 4 units that are in stock, right? The units that are in stock are all at the old cost at $3.60. Then on August 26, Smart Touch Learning purchases 12 units of inventory at a cost of $3.80, right? Then you sold 10 units. The oldest inventory were 2 units remaining from the August 5th purchase, so 2 of the 360 ones. So So they get first, and then whatever is left, the remaining 8 units, come from the August 26th purchase, leaving 4 units at $3.80 in the ending inventory. So as people buy them, we're selling the oldest ones first, and we revalue our inventory as we go. Now, suppose we do it the other way. Last in, first out. LIFO. Method is an inventory costing method in which the last costs into inventory are the first costs out. This method leaves the oldest cost, those of beginning inventory, and earliest purchases of the period in ending inventory. When we sell items, we are usually unable to identify which specific items sold, since they are all homogeneous. For accounting purposes, we will assume that the units sold were the newest in inventory at the time of the sale. We will remove the newest units along with their costs from the inventory record, leaving the oldest units available to be assigned to the next sale. So we don't really know. I mean, you can imagine we just purchase these tablets and we put them all in a bin, and there's not any organization. It could be the old one, the new one, whatever. We're just grabbing one and handing it to the customer. So we don't really know if it's the oldest or newest one we're handing to the customer, but we're going to track it. We're going to track it as if the newest one is the one I'm giving to the customer. All right, so to look at that example, we have the same thing going on here. Our beginning inventory, 2 units at $3.50, then we purchase 4 units at $3.60, then we sell 4 units. Right, so kind of slightly different. Again, we're tracking those TAB 0503s at the beginning. After the purchases, we have 6 units. 2 at $3.50 plus 4 at $3.60. On August 15th, we sell 4 units. Under LIFO, we assign all 4 units from the August 5 purchase along with their cost to the sale. So when we sold those 4, we sold the 4 we bought at $3.60, right? Which means our cost of goods sold is 4 times $3.60, and our inventory remains 2 times $3.50, or $700. Right? So we're doing it the opposite of the way we did it under FIFO. Right? Then comes along August 26th, and we purchased 12 units of inventory at $3.80 each. Then the sale says, oh, we sold 10 units. So that means the newest units were from the 12. So from the first in, first out, it's 10 times $3.80 is what we sold. And what's left in inventory are those same 2 that we had at the beginning at $3.50, and then 2 at $3.80. All right, so first in, first out. Last in, first out. So whichever order it tells you is just how you keep track of them, and you just do it perpetually going along. Obviously, you can't sell something you don't have, so we're tracking it as we go along. It's perpetual, but that's how we do it. And that is it. That's LIFO versus FIFO. In class, we'll practice doing some of those. Okay, good luck with LIFO and FIFO.